Let's be real for a second. We've all seen the shows, we've all heard the stories. Someone buys a duplex, rents out one side, suddenly they're on the path to financial freedom. Real estate investing has this almost mythical status in our culture. It's presented as the ultimate way to build wealth, a tangible asset you can see and touch, and for a lot of people it really is. But let's not forget the other side of that coin. Frustrated landlord on phone with broken pipe versus smiling person at laptop with stock chart. The late-night phone calls about a leaky toilet, tenants who mysteriously disappear without paying their last month's rent, the sheer amount of cash needed for a down payment. It's a lot of work and a lot of money. Becoming a landlord is a full-time job on top of your full-time job. It's a massive commitment, not for everyone. I've seen it firsthand. People get excited about passive income from rentals, but they quickly discover it's anything but passive. You're dealing with repairs, chasing down rent checks, navigating complicated local housing laws. It's a huge headache. The financial barrier is incredibly high. Most of us don't have an extra 50 grand for a down payment, let alone the time and energy to screen tenants, or fix a broken furnace. This is where the conversation usually stops for most people. They hear real estate investing and think hassle plus huge upfront cost. And they say, nope, not for me. They go back to stocks and bonds. The dream of owning a piece of the property market fades away. It feels like an exclusive club, secret password required. But what if I told you there was another way? A way to get the benefits of real estate investing, the income, the appreciation, the diversification, without ever having to answer a tenant's call at 3 a.m. That's where something called a REIT comes into the picture. You might have heard the term but not known what it means. REIT, Real Estate Investment Trust. Think of it as a company that owns income-generating real estate, or operates income-generating real estate, or finances income-generating real estate. And you can invest in them like any other stock, like Apple or Tesla. This one simple tool completely changes the game. It opens real estate to anyone with a brokerage account and a few dollars to spare, democratizing access to one of the most powerful wealth-building engines in history. Alright, so I've thrown this term REIT at you. So, what is a REIT? But let's break down what it actually is in the simplest terms possible. Imagine you and 100 of your friends all want to buy a massive, multi-million-dollar shopping mall. None of you can afford it on your own, obviously, but if you all pool your money together, you suddenly have enough capital to buy the property. You then hire a professional management team to run the mall, collect rent from all the stores, handle maintenance, and find new tenants. At the end of the year, after all the expenses are paid, you and your friends split the profits. That, in a nutshell, is the basic idea behind a REIT. A REIT is essentially a company that pulls together capital from thousands of investors to buy and manage a portfolio of real estate properties. These aren't just single-family homes either. Sprawling apartment complexes, giant office buildings in downtown skyscrapers, massive warehouses used by companies like Amazon, luxury hotels, and even data centers that power the internet. A REIT gives you a chance to own a tiny slice of all of them. The magic of the REIT structure is actually baked into the law. To qualify as a REIT, a company has to follow some very specific rules. One of the most important rules is that it must pay out at least 90% of its taxable income to shareholders in the form of dividends. This is huge. It means that when the REIT collects rent from its tenants, that money doesn't just sit in a corporate bank account. The vast majority of it flows directly back to the investors, people like you and me. This is why REITs are so popular with investors who are looking for a steady stream of income. So, when you buy a share of a REIT, you're not just buying a piece of a company, you're buying a piece of its underlying real estate portfolio. It's listed on major stock exchanges like the New York Stock Exchange, so you can buy and sell shares with just a few clicks on your phone. This makes it incredibly liquid, meaning it's easy to get your money in and out. This is a massive advantage over owning a physical property, which could take months or even years to sell. You get the benefits of property ownership with the convenience and flexibility of the stock market. It's the best of both worlds. Okay, we've covered what a REIT is, but the big question remains, why should you, an everyday investor trying to build wealth, actually care? The answer comes down to a few key things that make REITs a powerful addition to almost any investment portfolio. First and foremost is diversification. You've probably heard the old saying, don't put all your eggs in one basket. This is investing 101. If all your money is in tech stocks, and the tech sector takes a hit, your entire portfolio goes down. Real estate often moves differently than the stock market, so adding REITs can help smooth out the ride. When the stock market is volatile, the income from real estate rents tends to be much more stable. People and businesses still need places to live and work, regardless of what the S&P 500 is doing on any given day. By investing in a REIT, you're not just diversifying away from stocks, you're also diversifying within the real estate asset class itself. A single REIT might own hundreds of properties across different states and even different countries. You could own a piece of an apartment building in Florida, a medical office in Texas, a shopping center in California, all through one single investment. Achieving that level of diversification by buying physical properties would be impossible for most people. The second major reason to care about REITs is the income potential. As I mentioned before, REITs are legally required to pay out at least 90% of their taxable income as dividends. This creates a reliable and often substantial income stream for investors. For people nearing retirement, this dividend income can be a fantastic way to supplement their living expenses. For younger investors still in the wealth-building phase, they can automatically reinvest those dividends to buy more shares, allowing their investment to compound and grow exponentially over time. It's like getting a paycheck from your investments. Finally, there's the simple matter of accessibility and simplicity. Let's face it, direct real estate investing is complicated and expensive. With a REIT, you can get started with as little as the price of a single share, which could be less than $100. There are no mortgages to apply for, no property taxes to pay directly, and no contractors to deal with. You're handing over all the landlord duties to a team of seasoned professionals whose job it is to maximize the value of the portfolio. This allows you to participate in the potential upside of the real estate market without any of the operational headaches, making it a truly passive investment that works for you in the background. So we've established that a REIT is your ticket to playing in the big leagues of real estate. But it's not quite as simple as just picking one and calling it a day. Just like ice cream, REITs come in a few different flavors, and knowing the difference is key to making a smart investment decision. The most common type, and the one most people think of, is the equity REIT. These are the companies that physically own and operate properties. They are the landlords of the commercial real estate world. When you invest in an equity REIT, you are becoming a part owner of their actual buildings. The steel, the concrete, the glass. It's the most direct way to own a piece of the property pie without getting your hands dirty. These equity REITs specialize in all sorts of property types. Residential REITs that own massive apartment complexes with thousands of units. Retail REITs that own the shopping malls and strip centers you visit every weekend. Office REITs that own the downtown skyscrapers where people work. Industrial REITs that own the giant warehouses and distribution centers that are the backbone of e-commerce. Each of these subsectors has its own unique risks and rewards. For example, the rise of remote work might put pressure on office REITs, while the continued growth of online shopping is a massive tailwind for industrial REITs. The variety is huge, which is great because it lets you target specific parts of the economy you believe in. Then you have the second flavor, mortgage REITs, or MREITs for short. These are a different beast entirely. Instead of owning physical properties, MREITs deal in the financial side of real estate. They don't own buildings, they own the debt on the buildings. They make money by lending money to real estate owners and developers, or by investing in mortgage-backed securities. Think of them as the bank. Their income comes from the interest they earn on these mortgage loans. It's a way to profit from the real estate market without ever touching a single brick. They are essentially playing the spread between the interest they earn on their investments and the cost of funding those investments. Because their business is based on interest rates and financing, MREITs can be a bit more complex and volatile than equity REITs. Their performance is heavily tied to the direction of interest rates set by the Federal Reserve. When interest rates are fluctuating, the value of their portfolio can swing pretty dramatically. This makes them a bit riskier, but they often pay out even higher dividends to compensate for that risk. It's a higher risk, higher reward play within the REIT universe. They offer a different kind of exposure to the real estate market, focused on the lending and financial mechanisms that make all those big property deals possible. Understanding this distinction is crucial before you dive in. Let's dig a little deeper into the mechanics of how a REIT actually generates the cash that ends up in your pocket as a dividend. For an equity REIT, the primary source of revenue is simple: rent. Just like a landlord collecting rent from a tenant in a duplex, a REIT collects rent from all the businesses and individuals leasing space in its properties. An apartment REIT gets rent checks from thousands of tenants. A retail REIT gets them from stores like Target, Starbucks, your local grocery store. An office REIT gets paid by the corporations that occupy its buildings. This rental income forms a predictable and steady stream of cash flow for the company. But collecting rent is just the first step. To be successful, a REIT needs to manage its properties effectively to keep expenses low and occupancy rates high. A professional management team is constantly working to sign new long-term leases, renew existing ones, make sure the properties are well maintained and attractive to potential tenants. A well-run REIT will aim for high occupancy, an empty storefront, a vacant apartment. They're also always looking for ways to increase revenue, perhaps by making strategic upgrades to a property that allow them to charge higher rents, which ultimately boosts the bottom line for investors. On top of the rental income, equity REITs also make money through property appreciation. Over time, well-located real estate tends to increase in value. A REIT's management team is always analyzing the market, looking to sell properties that have reached their peak value, reinvest the profits into new properties with greater growth potential. When a REIT sells a building for more than it paid, that capital gain adds to the company's overall value. This increases the value of your shares, which is known as capital appreciation. So you can make money in two ways: regular dividend income, long-term growth in the share price. For mortgage REITs, the money-making process is completely different. Their profit is generated from their net interest margin. This is the spread, or the difference, between the interest income they earn on their mortgage assets and their cost of borrowing. For example, an MREIT might borrow money at a short-term interest rate of 3% and use that capital to buy mortgage-backed securities that pay out an average interest rate of 5%. That 2% difference is their profit. Their entire business model revolves around managing this spread and navigating the complex world of interest rate fluctuations, which requires a highly skilled management team that understands the bond market inside and out. Okay, this all sounds great in theory, but how do you actually go from reading this to owning a piece of a REIT? The good news is, it's probably way easier than you think. The most straightforward way is to buy shares of an individual publicly traded REIT on a stock exchange, just like you would buy a share of Apple or Microsoft. Open a brokerage account: Fidelity, Charles Schwab, Robinhood, M1 Finance. Search the REIT's ticker symbol, click buy, a few clicks and you own it. Research specific REITs: Prologis, industrial warehouses; Avalon Bay Communities, apartments. Decide which sectors to invest in. This approach gives you the most control. Handpick companies you believe in. Build a custom portfolio of properties. It requires more research. Dig into company financials, review property portfolios, evaluate management teams, understand sector-specific risks. Great for hands-on investors who like research. But picking individual REIT stocks can feel overwhelming. You're putting faith in one company's performance. Concentrated risk. Simpler option: invest in a REIT ETF or an exchange-traded fund or a mutual fund. An ETF is a basket holding dozens or hundreds of REITs. Buy one share and you're instantly diversified across real estate. Example: Vanguard Real Estate ETF. Exposure to equity, REITs, residential, retail, industrial, with one purchase. Set it and forget it. For most beginners, a REIT ETF is the best way to start. It removes guesswork. You get broad diversification, professional management, low costs. Buy and sell it like a stock. Capture the whole real estate asset class without being an expert. Buy the fund, set up automatic investments, let your real estate position grow on autopilot. Let's talk about one of the most attractive words in the investing world: income. When you invest in most growth stocks, you're betting on the company's future success, hoping the stock price goes up over many years. That's great, but you don't see any of that cash until you decide to sell. REITs play a different game entirely. As we touched on earlier, they are legally structured to be income-generating machines. The law requires them to distribute at least 90% of their taxable income back to their shareholders. This isn't a suggestion or a company policy, it's a hard and fast rule they must follow to maintain their special tax status as a REIT. This simple rule is the foundation of their appeal. This mandatory payout structure creates a powerful and often predictable stream of passive income in the form of dividends. Think about it. The REIT owns a portfolio of high-quality properties, collects rent from hundreds or thousands of tenants every single month, pays its operating expenses, and then sends the bulk of the remaining profit directly to you, the shareholder. It's like being a landlord who gets their cut of the rent without ever having to chase down a late payment or fix a leaky faucet. This consistent cash flow is incredibly valuable, especially for investors who are looking to supplement their regular income or build a fund for retirement. For younger investors who are decades away from retirement, these dividends are just as powerful, but in a different way. Instead of taking the cash, you can set up what's called a dividend reinvestment plan, or DRIP. Most brokerage accounts let you do this automatically. When the REIT pays a dividend, your broker uses that cash to buy more shares of the same REIT. This creates a beautiful compounding effect. Your new shares will then generate their own dividends, which buy even more shares, and the cycle continues. It's like a snowball rolling downhill, gathering more snow and getting bigger and bigger over time, all without you lifting a finger. This focus on dividends provides a certain level of stability and return that you don't always get from other types of investments. Even if the stock market is flat, or the REIT's share price isn't moving much, you are still getting paid. That regular dividend provides a tangible return on your investment, quarter after quarter. In a world where financial markets can be incredibly volatile, having an asset that consistently puts cash back into your pocket can be a huge psychological and financial advantage. It's a way to get paid while you wait for the long-term appreciation of the underlying real estate to kick in. One of the golden rules of smart investing is diversification. You've heard it a million times. Don't put all your eggs in one basket. If your entire net worth is tied up in a handful of tech stocks and the tech bubble bursts, you're in serious trouble. This is where REITs truly shine as a portfolio building tool. Real estate as an asset class often behaves differently from the traditional stock and bond markets. The factors that drive rent prices and property values, like local job growth, population trends, new construction, are often disconnected from the daily swings of the S&P 500. Adding REITs can act as a stabilizing force in your portfolio. When you buy a share of a single REIT, you're not just buying one building, you're instantly diversifying across a whole portfolio of them. A large apartment REIT might own hundreds of properties spread across dozens of cities in different states. One investment gives you a piece of the rental market in sunny Florida, bustling Texas, and growing Arizona. This geographical diversification protects you from a downturn in any single local market. If the economy in one city slows down, the strong performance in other cities can help balance things out. Achieving this kind of widespread ownership by buying physical properties would require millions of dollars and, honestly, a logistical nightmare. But the diversification doesn't stop there. You can also diversify by property type. Office buildings, shopping malls, data centers, self-storage facilities, hospitals, industrial warehouses. Each of these sectors responds to different economic trends. The rise of e-commerce, for instance, has been a massive boom for industrial REITs that own logistics centers, while it has created challenges for some retail REITs that own traditional malls. By investing in a broad REIT ETF, you can own a slice of all these sectors at once, spreading your risk and capturing growth wherever it occurs. This multi-layered diversification is what makes REITs such a powerful tool for building a resilient long-term investment portfolio. By adding an asset that has a low correlation to the broader stock market, you can potentially reduce your overall portfolio volatility. This means smoother returns over time, fewer gut-wrenching drops, and a more stable path toward your financial goals. You're not just betting on stocks anymore, you're also betting on the tangible, income-producing world of commercial real estate. It's a foundational piece that can make your entire investment strategy stronger and more robust against the inevitable ups and downs of the market. We've just scratched the surface of what makes REITs such a fascinating investment. If you're finding this breakdown helpful, do me a favor and hit that like button and subscribe for more deep dives into the world of investing. And I want to hear from you. What's the biggest question you still have about REITs? Drop it in the comments below, and let's get a conversation started. Now let's get back to it, because understanding the rewards is only half the battle. Next up, we're talking about the risks. Now, before you go and dump your entire life savings into REITs, we need to have a serious talk about the other side of the coin, the risks. No investment that offers the kind of rewards we just talked about comes without risk. Anyone who tells you otherwise is selling something. The first and most obvious risk is market risk. Because most REITs are traded on public stock exchanges, their share prices can be just as volatile as any other stock in the short term. When the overall stock market has a bad day or a bad month, REITs often get dragged down with it, even if the fundamentals of the underlying real estate haven't changed one bit. Fear and panic can cause investors to sell everything, including their REITs. This means you have to be prepared for prices to go up and down. If you panic and sell at the first sign of a downturn, REITs might not be for you. For example, during the initial shock of the 2020 lockdowns, REITs across the board took a massive hit, especially in retail and in office spaces, as fear about in-person activity spread like wildfire. While many have since recovered, it was a brutal reminder that REIT prices are not immune to market sentiment and sudden shocks. You have to have the stomach to ride out these waves and trust the long-term value of the assets. Another huge risk factor is interest rate sensitivity. This is a big one, so pay close attention. REITs often carry a lot of debt to finance large property acquisitions. When the Federal Reserve raises interest rates, it becomes more expensive for REITs to borrow money to buy new properties or refinance existing debt. This can squeeze profit margins and slow growth. Higher rates also make lower-risk investments like government bonds more attractive. If an investor can get a guaranteed 5% from a bond, a 6% dividend from a riskier REIT looks less appealing, which can put downward pressure on REIT stock prices as investors shift money. This relationship can make REITs behave a bit like bonds at times. When the market expects rates to rise, REITs often underperform. We saw this play out clearly in 2022 and in 2023 as the Fed aggressively hiked rates to combat inflation. The entire REIT sector faced significant headwinds. This is especially true for mortgage REITs, whose business model is based on interest rate spreads. A sudden or unexpected change in rates can completely upend their profitability. Understanding that REIT performance is closely tied to the macroeconomic environment and central bank decisions is critical before you invest. So, here we are at the end of our deep dive into the world of real estate investment trusts. We've covered a lot of ground, the absolute basics of what a REIT is, how they make money, and the specific risks you need to watch out for. Main takeaway: REITs democratize real estate. Become a landlord of skyscrapers, shopping malls, massive apartment complexes with a few clicks and potentially under $100. Rewards: consistent dividend income and potential long-term appreciation without ever having to unclog a toilet or screen a tenant. The single most important piece of advice: adopt a long-term mindset. Real estate investing is a marathon, not a sprint. Plant a financial tree today so you can enjoy its shade and fruit years from now. Be patient, be consistent, trust the process. And now, for what is arguably the most important section of this video, I need to be crystal clear about something. While I am passionate about financial education and sharing what I've learned over the years, I am not a licensed financial advisor, a fiduciary, or a registered investment professional. The information presented here is for educational and informational purposes only. It is not to be taken as personal financial advice, investment recommendations, or a solicitation to buy or sell any specific security. Your financial situation is unique. Your goals, your timeline, your income, your debt, your tolerance for risk. It is absolutely essential that you do your own thorough research. This is your hard-earned money we are talking about, and you are the one who is ultimately responsible for it. Never invest in something you do not completely understand. The best course of action is to consult with a qualified and licensed professional, a certified financial planner, a registered investment advisor. They can sit down with you, analyze your entire financial picture, and help you create a personalized plan that is tailored to your specific goals and needs. Investing in a few hours of professional advice can be one of the best financial decisions you ever make. It can save you from costly mistakes and set you on the right path toward achieving financial freedom.